What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is April 19th of 2023. Well, folks, I hope you are having a fantastic day wherever you are, because in today's video, I not only want to do some technical analysis on where we see Bitcoin's price going over the next coming weeks, but more importantly, I want to talk about a big question. Are institutions really on-ramping into the crypto space? And what metrics can we gauge in order to try to understand what institutions are thinking of the crypto space? We've got some really interesting charts we're going to be diving into in today's video, so if you guys happen to enjoy my rambling, consider dropping a like, and whether you agree or disagree, I hope you guys will stay tuned to the end, so hopefully you can get some value out of the video. All right, let's go ahead and kick things off. So I want to start here by just talking a little bit about Bitcoin's price. As you guys know, we've been focusing a lot as of recent on this channel between $28,000 to $32,000 or $33,000. This is the contestant range of prior support back during the last bull market, and we have a strong feeling that this is going to be a range where we spot resistance. And as many of you know, we put a video out a little while ago where we talked about getting prepared for a potential short position, or at least, if anything, leaning towards taking a bet to the downside if we are to take any action. Doesn't mean that we've opened up a position just yet. We are still waiting on the silence, and I'll explain why that is. We've been in cash here since around $25,000 back in August. And the big reason for this here is not only considering the macro environment, but the fact that we believe we are in a longer term downtrend. This is not going to be a typical bear market. And because of that, there's going to be some pretty strong relief rallies, and we only really want to take shorting opportunities, or essentially bets on Bitcoin's price going down, when we start to see prices get to exuberant levels in the short term, where there are those exuberant opportunities to short and take advantage of heightened prices in order to trade them to the downside. We're not so much big fans of trying to trade to the upside during a period of time where it's been unfavorable and the macro environment has continued to contract. Now, one of the big things that I want to focus on here is that we've got two of our key indicators here. We've got our main momentum indicator that we talk about within the Dash Report, our newsletter here in the channel, and we also have as well one of our key partners here, Lux Algo. This is one of their main different types of momentum indicators that can signal shorting and longing opportunities. And I use it in a very unique way. I kind of cut out the labels here, and I like to focus on the overall trails or bands that follow with price. We're taking a look at the weekly time frame. And for me personally here, what I'm looking for is kind of my two-stage confirmation that we're going to be moving further to the downside is not only a red flip here on the weekly time frame on our key momentum indicator, which we have not seen just yet. We've been, as you can see, flipped blue after this weekly candle in January. So from that point on, throughout there, you can see that we've seen a 50% return from around that 20K price range when the indicator went blue. Not bad if you can capture those returns. But on top of that, we can see that this also helped us avoid chasing a lot of relief rallies outside of a few minor blue blips here on the key momentum indicator. Will easily allow us to get out on the next candle and basically avoid all this downturn within the markets. This is one of my favorite time tested indicators, not just in Bitcoin, but also in the broader crypto space and equities and Forex and commodities, pretty much the whole macro space. So this indicator to me has a lot of weight as to whether or not we're finally ready to start that shorting opportunity, which is why we are in cash. And the second one is going to be if we come back down into this kind of ascending trailing bar here for Lux Algo, if we are going to see price be able to hold on that, or if we snap through it. If we snap through it, we switch towards a new resistance band, and that again is exactly what happened throughout the vast majority of the bear market. And on the counter end, that's what happens during the bull markets. We build a new support band. That's exactly what's signaled here alongside our key momentum indicator in July of 2020 that allowed us to capture the vast majority of the cycle. And this is why I always emphasize not to FOMO in. And speaking about FOMOing in, I want to go ahead and talk a little bit about these institutional companies we keep hearing about, the institutional inflows of capital that's just supposedly buying up all the Bitcoin, is just going to go long on crypto and long all your favorite altcoins. All right, so I want to go ahead and talk about that and try to digest that today and see whether or not all that noise is really substantial. Do we really have institutions rushing to buy cryptocurrencies? I just want to let you guys know, if you're interested to get access to this indicator here, whether it be our key momentum indicator or Lux Algo, you can either subscribe to the Dash Report to get access towards our key momentum indicator at a link down below in the description. You get 20% off for an annual subscription. Or if you guys are interested in Lux Algo, I'll leave a 30% discount code down below in the description. You can get any package you want, monthly or annual. It doesn't matter, quarterly as well. It's one of the options. It's a great tool. It's one of the few tools we use here alongside our partner Bookmap that really helps us to gauge some interesting market insights and capture the big moves. That's what we're here for. Now, let's go ahead and dive into some really interesting charts. Now, you guys, when you think about institutions getting into the crypto space, many people probably think of people going towards Coinbase or Binance or these kind of exchanges that we utilize in order to purchase crypto assets. And to be honest, institutions is a bit of a broad term, right? If you're talking about crypto hedge funds, or if you're talking about just large high net worth individuals, angel investors, people who really have a large amount of capital that they want to dispose towards innovative sectors like crypto, yeah, that could very well be the case that they use that. And yes, maybe even some larger clients will use tools like Coinbase Institutional. They'll use different types of exchange on-ramps that may be tailored towards those individuals and those participants. But even though we can look at spot Bitcoin price, and while, yes, there are some institutional on-ramps in this space, especially stablecoin liquidity as well, there is one sector that I think does a better job than anywhere else when it comes to really gauging institutional interest. And that's what's going on in publicly traded companies for cryptocurrencies. Now, the reason why I think this is a very good telltale sign is for two key reasons. One of them is that this is already within the environment where liquidity lives, where a lot of institutional capital is. Essentially speaking, when people talk about institutions, people are usually thinking about very high respected hedge funds, large net worth, different types of fund structures that would basically build investment vehicles that would start to purchase or get exposure towards some of these companies, ETF products, etc. Essentially speaking, a lot of that institutional liquidity, I'm talking about the big boys here. I'm not talking about some couple $1 million crypto hedge fund or VC fund. I'm talking about billions upon billions of dollars, if not trillions of dollars of liquidity that could be allocated to this space, is living within the equity space, where dollars are trading between publicly traded companies, not digital assets directly. And this can tell us, if we take a look at a very specific chart, not just looking at the price of those equities, right? Already we can see some worrying signs just looking at their normal prices. But what really helps us to demonstrate whether or not Wall Street, so to speak, is optimistic about crypto is ratios. And this is something that we do that a lot of other investors and people out there in the crypto space just don't take the time to do. And the reason why I think it's important is it's going to let us know whether or not the momentum we're seeing in, say, the correlated asset, in this case Bitcoin, is really justified. Right? So let's go ahead and take a look here at coin divided by BTC USD. You guys can go ahead, type this in your chart. First, you type in coin, hit the down arrow here on TradingView to make sure you've got the right stock selected, and type in a forward dash line BTC USD. Go down to spot crypto index or the all-time history index, hit enter. And voila, you've got the chart that I've got except for the trend lines, which you can draw yourself. We're on the logarithmic scale because that is important in order to get the full scale of the chart. We've kind of zoomed out here just so we can kind of have the chart centerpiece here. Now, what you'll notice is that Coinbase, ever since its IPO'd, has been on a general downtrend here because it came out at a exuberant valuation, matching towards the exuberant times in Bitcoin's price. It basically launched around the time Bitcoin set in its May top. So that's no surprise that Coinbase was trading at such a premium. But if we take a look here over the long term, it's built these really great bands here as we travel throughout time. And I would assume that eventually one day we will likely break those, because when times get optimistic again, the premium people will pay on Coinbase will likely be higher. And it makes sense because as times get good, there is more fee revenue. As much as Coinbase is trying to become more of like a nimble business that does well during bull and bear markets, either way, they are succumb to the market forces. There's going to be more trading activity and more opportunities to generate revenue and therefore profit during a substantial long-term bull market. And that's what I want to get to here, because Wall Street and large-scale investors are going to price in whether or not they really believe that that's coming, right? So you can see, for example, after the collapse in May here, right, we did see an acceleration higher, but we faded afterwards. Ever since there in August, we continue to move lower. But hey, here in December, towards January, when we had really nice momentum in price, Coinbase started to trade a little bit higher, but still continues to fade here, down towards a ratio of 0.0022. Now, the number is kind of abstract, right? We just want to focus on here as to whether or not is Coinbase outpacing Bitcoin. It should generally be outpacing Bitcoin because the longer Bitcoin holds up in these heightened territories and likely supposedly signals that we're in a new bull market, Coinbase should be following, if not outpacing it. Well, over the past few months, since January, where we saw the vast majority of the momentum in this upswing, and ever since we've had some choppy, slight moves to the upside, for sure, it's continued to progress. I'm not going to deny that. But generally speaking, we got up into that $24,000 range and have been kind of chopping up. And look at what Coinbase has been doing here. Not making the same kind of momentum move to the upside. It's back where it was in December versus Bitcoin's price, or where it was back in May and June of 2022. So this is not what signals really heightened momentum for me personally. But maybe Coinbase is just a siloed viewpoint. Perhaps people just feel that the business is still overvalued and this is an anomaly. Well, let's go ahead and take a look at a company that is more directly exposed and valued to Bitcoin, and that is MicroStrategy. MicroStrategy, as you all know, is basically converted its entire business model. It's basically kind of ditched the existing revenue that it's going to be making from its business, any potential profit. They've kind of gotten rid of those assets in order to borrow short-term capital in order to go out and purchase Bitcoin at a relatively low interest rate. Essentially, MicroStrategy is the Bitcoin ETF that everyone has been waiting for, so to speak. Essentially, their balance sheet is supposed to track with Bitcoin's price. And what you find here is that during periods of optimism, right, we can see that generally this is a period of time where MicroStrategy can outpace Bitcoin. But even since back here in August, time and time again, we've been setting in lower highs for MicroStrategy and its performance against Bitcoin. But should this really be happening? Shouldn't we be seeing, as institutions are supposedly really bullish on crypto, shouldn't we see people taking the most easy available on-ramps into getting into these assets and getting that exposure? This to me tells me that financial markets, specifically Wall Street, is not buying it. They do not believe the rally. This should be trading at a higher premium over time. And sure, we are at higher lows than where we were back in May. I'm not going to deny that. But since back in August, we've been trending lower and lower. People have been taking advantage of these opportunities, distributing and selling positions when there is that short-term optimism, which isn't really a good sign for a long-term uptrend. So this to me is one of the biggest giveaways. But if there is one other that we need to take a look at, it is the time-tested, long-standing issue, what we call the kind of dark shadow. I don't want to be too clickbaity or too fear-mongering. I just really want to emphasize how this is a very big problem for the crypto space. I got to be honest with you guys that this is a very big concern, and unfortunately, not enough people are really talking about it. And that is the continued discount, less than a third of the value, right? The discount in the GBTC exchange-traded note. This is a Bitcoin financial instrument that trades on public markets that is supposedly backed 1-to-1 to Bitcoin. Now, there have been all types of rumors as to whether or not that is true or not. I'm not even here to disparage that. What I actually think is much more likely the case, because this is a publicly traded product and it would be very bad if it's not backed by 1-to-1 Bitcoin. That would be a big problem. But there's another big problem that could be very well even more realistic, and that is the fact that GBTC as a product bought way too much Bitcoin off the spot market in the last bull market, and now there is just not simply demand from people in brokerage accounts or traditional investment funds to purchase said Bitcoin. And sure, there's the 2% maintenance fee every year and stuff. Look, as much as that is obviously a negative over a, say, 30, 50-year time horizon, at the end of the day, it's nothing in compared to what kind of returns we should be expecting from Bitcoin, right? So I don't see that as an argument here to keep people from buying the GBTC product. 2% is negligible when it comes to Bitcoin. That's why MicroStrategy is fine paying 1%, 2%, 3% interest in order to borrow any capital it can get in order to go out and buy Bitcoin, right? Almost actually taking it back here to June of 2022. We've continued to see this 1/3 discount against the actual valuation of the underlying Bitcoin. This tells us that there's still too much supply on the open market versus demand. And until this discount starts to really correct back up, back to spot value, and continue that trend up, this is likely a relief rally. If this continues to get worse, that is an even more telltale sign that it's time to expect lower prices and that this rally does not have the legs to continue moving higher. I just want to be realistic with you guys here because relief rallies can be incredibly deceiving. And there's too many people telling you about what you're going to miss out on if you don't invest now, and they're not thinking about what you can afford to lose because, well, they have a business model of getting you to trade, getting you to think with emotions, pushing referral links towards leverage trading exchanges where you'll lose everything. I'm not saying we don't have sponsors or partners here on the channel. Everyone's got to make a business at the end of the day, and you got to promote the tools that you really feel valuable. Unfortunately, a lot of people are promoting you going out and trading, and they make their revenue from your expense, essentially you losing money and getting liquidated. That is not a good business model in my mind. And I'm not going to sit here and promote that you guys should go out and take overt risk in the market. Plain and simple. Don't want to put myself on a pedestal, but I got to be honest with you guys. It's not something I think is a good thing at the end of the day. And to be honest, it's not something you should expect from a trustworthy content creator, my honest opinion. Right? I'll say it here today. I've been saying it for years. It's not something that we want to promote here on the channel. Right? So at least know that at the end of the day, whether you guys agree or disagree with me, just know my intentions. My intentions here are to share my honest opinion and hopefully help you guys capture the really big moves. Capture the next bull market. We don't want to miss out on it. We don't have any incentive to be overtly negative, right? We are definitely going to be making those moves when the time comes, when we get our momentum flips. And speaking of that, it's not just again in crypto. As we've emphasized before, since back in March of 2022, our momentum indicator has signaled on the monthly time frame that we are likely in for a long-term downtrend. And unlike the past few times where we had this happen, say in February and March of 2020, or the red flip here in December 2018, or the multiple ones that happened between August 2015 and 2016. I remember trading during that period of time. A lot of confusion, a lot of potential recession fears. All these times we got a small red flip are very different from what we had here, which was an extended red flip that has continued to hold since back in March of 2022. So this is why, again, I say that this is not your typical buy the dip opportunity. At least not according to history. What this is much more likely is the beginning of a longer term downtrend like we saw during 2008 or the dot-com bubble. And that's again what I want to emphasize here is that so far, whether it be the momentum indicator or this broader channel where usually accumulation happens, we have not been able to escape out of that channel as fast and swiftly as we usually do. We usually come out of this channel very quickly, signaling strong signs of momentum, but we're not seeing that just yet. So for me, I think this is, again, a relief rally where we're facing resistance at a typical range, and we're going to slowly but steadily start to move lower here and snap through that channel. How quick is it going to happen? When is it exactly going to happen? We don't know. But there's a really good sign that can let you know ahead of time when that's likely to start playing out. And that is when you start to see your market leaders, the leading plays that have been leading the way forward in increasing valuations and therefore driving up equities, they're starting to underperform against the broader sector of stocks. That is one of your telltale signs. And again, where ratios come into play that so many people aren't aware of. And I highly recommend you guys start using it in your trading strategy. One of those that we're talking about a lot in the Dash report is NVIDIA. So we divide NVDA. This is NVIDIA, one of the largest GPU manufacturers on the planet, which is obviously going to be the benefactor if AI has this exponential wave and never turns back or slows down and doesn't see any lack of growth. It just continues to accelerate. And as people are getting really excited about ChatGPT, new spin-offs and implementations like AutoGPT and autonomous agents, AI agents and stuff, all this kind of stuff that is still very early stage and quite theoretical, all this exponential potential, right? Obviously people are very excited about not just ChatGPT, but the GPU manufacturers that could power that AI revolution. And hence, since back in October, right, really during that period of time in November, I think when ChatGPT came out, NVIDIA has been accelerating higher. But since back in March, we've continued to stall. Now, I want you guys to just take a look here. We haven't gotten our red flip on the weekly time frame, so I'm not trying to sit here and be negative, but I want to emphasize that after we see a couple weeks of consolidation or sideways chop, that is usually your telltale sign that a momentum shift is coming soon. And we wait for that red flip, right? But it seems like the optimism, the kind of momentum and euphoria is starting to slow down a little bit. That perhaps markets got a bit ahead of themselves and simply drove this up due to it being a momentum trade, not a fundamental trade or long-term position. And that will likely lead to prices correcting lower, especially if we start to see the NVIDIA stock go below or perform less than the broader NASDAQ. That's your telltale sign, because if your market leaders are starting to fade, who can you turn to really drive the vast majority of the rally? That's exactly what happened in the last bull market. We had the FANG stocks leading the way, Apple continuing to be the titan that it was. Unfortunately, if NVIDIA, one of the few stocks that's really accelerated during this period of time, starts to fade, that's going to be your telltale sign to back out. Another one is Microsoft in the weekly time frame. Same period of time since back here in March. After having a really nice big move here, about 7.6% against the NASDAQ, since then we've been chopping sideways. And this to me, again, looks a lot like what we saw back here in March or April, right? Where we started to see a fade on these plays. Now, again, we don't know exactly how this is going to play out. We're not going to try to rush this, but we're mainly focusing here on the momentum indicators. Another one here, Meta, right? Meta has been accelerating higher because they've been laying off people. They've been cutting back on employees and costs. I want to ask you guys this here real quick. Do you think that's enough to double Meta's valuation and, get people excited about it and kick off a new bull market? I'm not saying there's anything wrong with swing trading. If you guys captured that momentum, all the best to you. That's awesome, right? But I'm trying to answer the question of whether or not it's time to really go long Meta stock. Is it time to go long Microsoft or NVIDIA for the next 3 or 5 years? Maybe 3 or 5 years out, perhaps, you'd still make a return. But what happens in between? A lot of chop and potentially a move back down to the lows, if not something relatively close to it or lower. Take a look here at Meta stock here against the NASDAQ ratio, right? We can already see here that the momentum indicator, again, does a great job of letting us know when to long, when to short, generally speaking. But I want to go ahead and just take a look here at the monthly time frame. We'll turn off the indicators, right? And I want you guys to see on the monthly time frame how things are playing out here, right? We had a key level of support where it was time to long Meta against the NASDAQ. But since back in February, we snapped at this range. And we came all the way down here to 0.0084 in the ratio. And since then, month by month by month by month, we have accelerated up here. Now, a lot of people, more now than ever, are feeling the FOMO. A lot of people didn't want to buy back then. Now everyone wants to buy. And do you really feel, as we're approaching previous support, right? For those of you who've been watching since 2017, what do I always say? Previous support usually becomes new resistance. This is what I'm afraid of everyone getting caught into. This is what I'm afraid so many traders are unfortunately going to get trapped into. They're going to get stuck with their positions. They're going to build leverage trades. They're going to go all in, buy call options, do all the kind of risk-on things that unfortunately don't pay off. And I'm not saying that Meta is going to dive off a cliff tomorrow. I don't have anything against Mark Zuckerberg or even betting against the metaverse or anything. It's nice to see a tech company at least trying to pivot or try and do something new. But I don't think that's why Wall Street's buying the dip. And it's certainly not, if it's just layoffs, it's not going to be what sustains a new bull market. So, anyways, guys, I've rambled a good amount today. I think it's time that I stop rambling. I hope you guys enjoyed this video, though. And again, as I mentioned earlier, whether you agree or disagree, if you made it this far, consider dropping a like. It's one of the best ways you can support the channel. I love doing this content here on this channel for you guys. And during bull or bear markets, no matter where we think we are, I'm going to be here with you guys every step of the way. I've been doing it since 2017, been trading since back in 2011, and I really enjoy doing what I do and getting to be here with you guys. It's a true blessing. So thank you guys for your continued support as always. If you guys want to check out our different tools or you want to check out the newsletter, check out the links down below in the description. It's a great way to support the channel and a great way to boost and bolster your trading strategy. But until the next one, everyone, I'll see you all in the next video. Take care, everyone.